Most retail traders believe tech giants are completely bulletproof during high inflation. But this weekend proved that theory entirely wrong. A massive hardware inflation shock just wiped billions off global tech indices. The real threat right now is not software or consumer demand. It is the explosive cost of raw semiconductor parts. This structural shift is catching thousands of retail investors completely off guard. On Friday, Apple shares plunged a staggering 6.1%. This single move wiped out $263 billion in value. The company shocked the market by raising prices for iPads and MacBooks. They blamed skyrocketing costs for memory and storage chips. The artificial intelligence infrastructure boom is swallowing global hardware capacity. Now tech giants are forced to pass these high costs to consumers. Microsoft quickly followed suit by raising Xbox console prices by $150. Investor anxiety over massive artificial intelligence infrastructure spending is growing rapidly. Public markets are now demanding a clearer path to actual profitability. The pain quickly spread across global tech supply chains. South Korea's Kospi index tumbled 6.9% in heavy trading. This sudden drop even triggered a 20-minute market circuit breaker. Japan's Nikkei index also dropped 4.5% on Friday. What most people don't know is how a hidden market event masked the damage. While individual tech stocks collapsed, a bizarre phenomenon happened on Wall Street. NASDAQ executed a record $459 billion closing cross. This massive liquidity event was driven by the semi-annual Russell Index reconstitution. Over 4.5 billion shares changed hands in less than 2 seconds. This massive institutional rebalancing provided artificial support to several declining indices. The S&P 500 managed to close only slightly lower after a choppy session. But beneath the surface, macro indicators are flashing bright red warnings. The U.S. Personal Consumption Expenditures Price Index surged significantly. Headline inflation crossed 4% for the first time since April 23. Core PCE inflation edged up to 3.4% annually. This is the Federal Reserve's preferred gauge of consumer price pressure. Markets now price an 80% chance of another interest rate hike. Traders should expect significant equity volatility as the new index weights take effect. Before you look at domestic stocks, the surprising part comes next in Europe. European shares slumped deeply as the technology sell-off crossed the Atlantic Ocean. But the biggest shock in Europe came from the industrial manufacturing sector. German automaker Volkswagen announced a historic restructuring plan over the weekend. The company is weighing up to 100,000 global job cuts. They also intend to slash future capital investments by 15%. The costly transition to electric vehicles is squeezing traditional auto manufacturing margins. For traders, shorting weak European industrial legacy companies remains a solid play. However, some bright spots emerged in specific European corporate actions. Exail Technologies surged after confirming active takeover talks with aircraft giant Safran. The proposed deal values the company at €128 per share. Meanwhile, the United Kingdom is navigating a massive political transition. Andy Burnham is preparing to enter Downing Street as the new Prime Minister. This follows the emotional resignation of Sir Keir Starmer early last week. The FTSE 100 index actually rallied late Friday to trim its losses. UK investors are aggressively buying the dip on high-yielding defensive assets. Fintech company ClearScore also hired JP Morgan to advise on a £2 billion listing. If you are finding value in this analysis, smash the subscribe button right now. Join our community to stay ahead of the markets every single day. This next twist in the commodities market, Boris, caught everyone completely off guard. Most geopolitical analysts predicted oil would skyrocket over $100 this weekend. A cargo vessel recently came under a direct military attack near Oman. Yet Brent crude oil futures did the exact opposite of expectations. Oil plummeted over 1.3% on Friday to $72. Prices have officially collapsed back down to their original pre-war levels. More tankers are safely exiting the strategically vital Strait of Hormuz. Supply concerns are easing as diplomatic efforts reduce global shipping disruptions. Furthermore, Saudi Aramco successfully resumed crude loading at its Ras Tanura export terminal. This facility had been facing operational disruptions for almost 4 months. OPEC is also facing internal structural stress that bears watching. The United Arab Emirates officially left the oil cartel back in May. Now, Iraq is threatening to exit if production quotas are not raised. A fractured OPEC means a massive surge in global oil supply is possible. For commodity traders, shorting oil on geopolitical spikes is proving highly profitable. Meanwhile, gold prices held steady around $4,050 an ounce. Gold is facing pressure from higher interest rate expectations worldwide. But it remains the ultimate defensive hedge against currency devaluation. The most dangerous trap for your money is actually hidden in fixed income. The global bond market just received an authoritative warning this Sunday morning. The Bank for International Settlements released its flagship annual economic report. The global central banking body issued a severe warning to sovereign bondholders. They stated near-record public debt levels are creating a dangerous financial nexus. Highly leveraged hedge funds are increasingly dominating the sovereign debt markets. This specific combination creates extreme structural risks for global financial stability. We could see more frequent and sharper drops in sovereign bond values. The U.S. 10-year Treasury yield remains elevated near 4.4%. Rising yields will continue to put a heavy lid on growth valuations. Savvy traders are avoiding long-duration bonds during this structural inflation wave. Instead, capital is rotating rapidly into short-term cash-like Treasury instruments. The era of cheap money and low interest rates is officially dead. Make sure to watch our deep dive video on central bank liquidity next. Look out for what happens on our very next market update video. See you in the markets tomorrow.